What's up, traders? Anthony Crudele here, and thank you for tuning in to the Futures Radio Show podcast. Today's panel discussion is covering today's FOMC announcement and Fed Chair Powell's conference. My guests are Aisha Tarek, industry and fundamental analyst, former corporate banker, and macro analysis at TraderAid.com. Markets and Mayhem, many of you know him on Twitter as Mayhem for Markets. Mayhem has experience analyzing flows, geopolitics, macro, systematic trading, and technical analysis, and he's really one of the best on Twitter, really giving it to us straight and explaining what's happening in macro land. He, too, is also a part of TraderAid.com. And then we have Tarek Booker, first time on the show, aka avid commentator on Twitter. He's an Aussie journalist, so we appreciate him coming up at who knows what time it is over there in Australia, and also commentator. Today's podcast is sponsored by TradeStation. If you're a serious futures trader and you want a powerful platform to match your skills, enjoy flexibility and trading power with TradeStation's award-winning platform. It is the platform that I used today to trade the FOMC meeting, and I'll tell you what, it held up well. Markets were flying around, and we're going to get to that in just a minute. And you can trade stock, options on futures, and of course, futures on TradeStation. And to learn more, please go to tradestation.com/Anthony. Now, before I get that panel in here, I want to remind all of you that Futures Radio Show podcasts are recorded and posted on iTunes, Spotify, and pretty much everywhere where you listen to your podcasts. Throughout today's live discussion, subscribers to the channel can ask us questions in the chat, and I recommend that you do. Put some questions in there, put some comments. We like to feed off that here on the Futures Radio Show, so please take a quick second and subscribe to the channel and hit that like button as I look forward to chatting with all of you throughout today's show. And now, let me pull in the panel, and I think we've got almost every time zone here. We've got, Aisha, what do you say? It's midnight by you.
It's midnight, yes.
And Tarek, it's 7 a.m. by you?
Yeah, 7 a.m. here.
And Mayhem, we don't know where he is. He's in the metaverse. It could be, he doesn't know, it could be any time.
There's no time here.
So I think what we do is we keep it simple. We start off, we go around the horn here a little bit, and we say, look at everybody. We saw the market reactions, especially late into the close here. Last few minutes always gets a little bit more action, accentuating kind of what people think about today's FOMC decision and conference. And I think we'll just start with you, Mayhem. We'll just go around that way. What were your initial thoughts on what the Fed did and what you took out of, maybe a little nuggets that you took out of what Fed Chair Powell was discussing?
Yeah, I think it was a Fed that remains resolute in their course. They've been trying to shore up the banking system with some of their emergency actions that he spoke to as being temporary, and he didn't really see it as anything resembling easing, and that this was just lending to banks to shore up liquidity. So I don't think the market really heard what it wanted to. Now, as this was all going on, there was a lot of hedges being unwound. There was a lot of buying happening, and people were focusing maybe a little bit on the idea that the Fed was closer to being done with tightening. But then he also spoke to the other side of the ledger that some of the things that are happening out there are doing our job for us. And so as a result of that, I think that we started to get the sense that this is a Fed that's still higher for longer. They're still sensitive more to inflation than they are to, the concerns of the banking system, having tried to assuage some of those concerns with the programs they've stood up, like that super discount window. And I think that gives them the runway to continue their policy path. And I believe that they want to try to battle inflation because they don't want it to become entrenched. That's the bigger risk in their mind. And honestly, that's the bigger risk in the way I see it as well. And we could see that things looked reasonably okay. And then as Powell stopped talking, the market started to run upwards. And then we just got a complete reversal and everything fell apart. But what really struck me today was the complete lack of liquidity on the order book of the ES June contract. I mean, I was watching it on Bookmap, and there was at times 4,000 or 5,000 contracts depth, which is just, that's like crickets. There's like no one there. I mean, a typical day, 20, 30,000, easy peasy. And that was some of the times where you saw these violent machinations in price up and down as well. And that goes back to the study of liquidity is negatively correlated with volatility, right? And so on the other side of that, when we have low liquidity, price just starts to get a little bit crazy. And I think that's one of the things we saw today. It didn't take much for sellers to get aggressive and really rip this market apart towards the close.
Yeah, I mean, I have to agree with almost pretty much everything you said because of the way that we saw the markets react. And I'm going to go to you next, Aisha. I know that you and Mayhem are chatting and talking all day long, and I know that you were talking to him a little bit about how when the market was going up, that you said really he's not saying anything good about that. And I know Mayhem got short. I'm a little upset that I didn't catch that one the way that Mayhem did, but I'm curious, what were your initial thoughts about what the Fed had done, 25 basis points, and maybe any nuggets that you pulled out of what he discussed today?
Sure. So I think the one thing that struck me was the times that he actually said that, credit conditions are tightening. And this is something that I discussed last week when, people were talking about QE and people were talking about easing and all of that. And I kept on saying that this is, a misinterpretation of what they're doing. So it's not exactly easing. If anything, banks are going to stop lending because they want to shore up the liquidity, right? So they want to keep their liquidity going. So he said exactly that. So it's good to hear it from the horse's mouth. However, whatever he said was not very positive. And as I was listening, and I like to take notes, so I was taking my notes and all of that. But then I'm also looking at the market, and the market is just going higher. And I was thinking to myself, and I told Mayhem that none of this makes sense. Like if the market actually understands what he's trying to say, that he doesn't have to tighten anymore. And he was a little pleased with it. I felt he was a little pleased with it because the market is doing his job for him, as Mayhem rightly pointed out. It's like this is exactly what they wanted. They wanted financial conditions to tighten. Now, whether you do that through QT or you do that through rate hikes, it doesn't matter for him. And the one interesting thing that he said is that this tightening of conditions is akin to multiple rate hikes, even. And that struck me as very interesting. And that's when I kind of thought, like, oh, yeah, and this isn't good. So this means that whether we see him actively hike or not, the conditions becoming tighter is actually bad for the market and bad for the economy. Uh, the level of uncertainty right now is a little scary. So I don't mean to be doom and gloom, but this is where we are at the moment. And I think we just need to be careful.
Yeah, let's go to you, Tarek. First of all, I see the sun shining up over there. You're getting the sun coming in, and we've got sun setting, sun's rising. And so we heard from Mayhem, we heard from Aisha. I don't know how much you caught of it today. I know it's quite early there for you. What are your initial thoughts about what you saw the Fed do today and what you heard from the conference?
My takeaway was just basically that it's steady as she goes. That Powell is trying to, sort of instill a level of confidence that everything's, okay. Everything's, there's all these issues in the banking sector, but the Fed is on top of things. We saw that with, say, for example, with the dot plot. There was a lot of people expecting that we were going to see this sort of pricing in of loosening later down the road, but that isn't really something that happened. And, Powell was very resolute that what we're going to see is basically going to continue. And to speak to Aisha's point about the fact that, we are seeing this tightening in financial conditions is something that can evolve quite rapidly. And I think that's something that Powell is really definitely keeping in mind at this point, because something that can tighten so rapidly can also loosen somewhat rapidly as well if we do start to see some level of normalcy return to the US banking system and to the banking system more broadly. And I think Powell really just wants to secure a legacy at this point. He's had his first term. This is his second. And under his leadership, the Fed has not looked good. It has looked quite bad. It got transitory inflation very, very wrong. They held off far too long on tightening rates. And now, there's even an argument that they stopped tightening aggressively too early. And, now we're in this position where they've got to balance the banking system and higher rates. And, maybe that's something that they should have done earlier. So I think that, I agree with Mayhem that there's definitely the higher for longer message in there, and they just really just wanted to sort of give that level of calm and just see how the financial conditions evolve over, say, like the next, what is it, 5 and a bit weeks and before the next Fed meeting.
And so I guess I want to ask all of you this simple question, right? So I guess the takeaway is, and why the markets reacted the way they did, is higher for longer. Was that the trigger that basically got the markets nervous because they were expecting the Fed not to necessarily say that and go that route? Is that what you guys are thinking?
Yeah, I think the thing is that Powell didn't provide the certainty that the markets wanted. The markets wanted some degree of certainty that if things start to get a bit more challenging, that we're going to see, the dot plots revise down. You're going to see that move towards loosening, and that sort of commitment against fighting inflation fade. But that hasn't happened here, and I think that there's that degree of concern of, well, what are they going to do now? Are they going to keep the hammer down for longer and longer and longer until we see something really start to break? And I think that's something that sort of spooked the markets a little bit.
Mayhem, Aisha, is that what you guys think too? Was that what the market took away today?
I think so. I think, Tarek is right. I mean, the level of uncertainty wasn't great. I mean, he was saying it quite a bit, right? And I think the other thing that may have spooked the market was the question around the rate cuts, because the market was pricing in rate cuts for this year, and he basically, flat out said that that's not in our base case. So, and he ended on that note as well. So I think that that's another thing that probably the market took away, that they are still, resolute in what they're going to do, just as Mayhem said.
Yeah, Mayhem, I want to go back to you. I want to ask you something specifically. You said
Sure.
you felt that you agreed with what the Fed had done. You said that you think that they did do the right thing, even though that this is going to be a negative. You think that ultimately this is probably a positive for down the road. Maybe that's the way that I interpreted it.
Yeah, I mean, I think we got to take the tough medicine now, so that down the road, inflation may not be as bad, but it's a tightrope that the Fed is walking. They're probably in the most unenviable position, outside of maybe the Bank of Japan and European Central Bank. But all these central bankers are in pretty difficult positions here. There's a great deal of responsibility. Almost no matter what they do could be considered the wrong decision later on for one reason or another. But I think inflation is the bigger problem. I think that the Fed has a very limited set of tools to try to subdue it. They can really only hit it from the demand side. And they're being fought by the legislative side, whether we're talking about the state level or the federal level, or even what's happening in some other countries like the reopening of China, which isn't a huge boom, but it's enough to offset some of those tightening impacts. And so is some of the Bank of Japan's policy and how the Treasury General Account's been spent, and some of these bills like the Inflation Reduction Act and the Chips and Science Act. This is all kind of countering the impact, when what we need is more supply of labor and energy and metals and agriculture. And the Fed can't do any of that, right? The most they can do in that capacity is make employment conditions maybe a little bit looser, in the sense that they get more people off the sidelines that aren't participating in the labor force and you get job openings to start to come down, and unfortunately firings to start to go up. That might be one way they can address that part of the equation, but the rest is just trying to subdue demand. And we've only just last week celebrated the first year since the first rate hike. And there's these lagged impacts, these variable time lags in the way that the policy impacts our economy and also our financial system. And I think we've started to see some of that. But I believe there's a lot more work to do. Inflation, as he said several times, it's still their goal to reach 2%, and it's unacceptably high. So I do believe we still have, a chair that's determined not to make the mistakes of Volcker. There are some parallels here. He's taking the other path. And bank failures, quite frankly, especially with everything that's happened, and Aisha knows better about this than I do, but there's a lot of banks that weren't running their shops very well. What happened there with Silicon Valley Bank and Signature Bank weren't really outlier events. They're almost to be expected. And if you think about some of the failures that have happened, crypto banks and venture capital banks, I mean, the Fed can kind of look at that and they'll grimace about the interconnectivity and the risks, but they'll also say, of all the kinds of banks that could have failed, that's not the worst thing. It is trying to, maybe tamper down on some of that speculative excess in those same areas, in tech startups, in crypto, and early stage companies, because there has been for way too long near emergency level, if not emergency level monetary policy for over a decade. And I think that that's created the biggest bubble, the biggest multi-asset bubble that we've ever seen. And so deflating that, it's going to take time, it's going to take determination, and things are going to break along the way. And I don't think the Fed really turns around until something big enough breaks, or to maybe they get to their goal, although that seems elusive.
And so essentially, I guess what happened with these regional banks, you don't believe was big enough. Obviously, the Fed doesn't believe it was something big enough for them to change course.
Well, they did do some very important things. And Aisha and I were talking off mic about this, that, it seemed like how quickly they had this stuff ready to go, that maybe they already had it on the side, kind of looking to put those things into effect. And that's something that she pointed out that I think is 100% right, because these are complex bureaucracies with lots of red tape. They don't typically act very quickly unless they're prepared. So I thought that was really interesting about the super discount window. And I think it's a great point that she should speak to more. But I also think that what they did was to try to kind of patch up the situation enough, specific to the liquidity mismatch in some of these banks between their assets and their liabilities, so that they can continue their tightening path. But in terms of bank failures, we just went through a couple of years of something extraordinary where there were no bank failures for 2 years in a row. And so to see some, even if they are larger, it's not that. I don't think it's the point at which they need to stop. Now, if we were talking about large banks in this country failing, then I think we'd have to have a different conversation. If we're talking about like a Citigroup or a Wells Fargo or something like that, that would be an entirely different conversation. That would be a U-turn point. But we haven't had a Credit Suisse moment here. We've had smaller banks that had mismatched risks because they had, in some cases, like Silicon Valley Bank, very bad management, lack of hedging, lack of really appreciating the kinds of exposure they had versus, what could happen in the event of a large withdrawal of their deposits. And that wasn't like representative of a larger contagion. That was one bank that really their management, I think there's going to be some investigations into how badly that situation went.
Yeah, one of the things I was going to talk to you guys about is if you felt there was going to be contagion, but you just answered that saying that you don't think that we're going to see that because you think this was just mismanagement of a single bank. Although there's so many experts out there on Twitter now, you never know what.
Well, so I would say this. I think there's risk of contagion later in this tightening cycle as things get worse and as the Fed's policy impacts, those lagged and variable impacts, really start to hit the financial system, and also as credit conditions tighten and inter-party trust erodes a bit here. I just don't know if that's, tomorrow, next week, next month. Yeah. I think it might be more of a second half of the year type of phenomenon. But who knows? Some of this has pulled some of these outcomes forward.
Yep. Aisha, I want to ask you a question about these regional banks, because this is not something that I really know much about, right? As a trader and investor, as this is all coming at us, there's so much information, it's overload. But Mayhem said that this wasn't a big enough thing would happen with the regional banks. If it was maybe Wells Fargo or somebody else like that, then obviously that would change the conversation. But my question is that if you have regional banks like this, where this is happening, I know I have a lot of friends that are in small businesses. I mean, I'm a small business, right? And some of the things that I do, isn't there a lot of risk that maybe, I don't know, that I don't realize that could happen because we start to have issues with regional banks? Because I know personally, I don't want to be in a world where I'm always reliant on JP Morgan or Wells Fargo. I mean, are we losing that? Like, is that maybe a risk that's something we don't see right now that eventually takes hold later? Or am I just not right in what I'm thinking there?
No, I think you're absolutely right in what you're thinking. So the regional banks do play a very important part. And as you're saying, that not everybody banks with the big boys, right? Most of the smaller businesses, and mind you, smaller businesses make up, the majority of businesses in the US and most countries of the world, right? So these regional banks, they actually play a very important part. Now, there's some debate as to whether the US has too many regional banks or too many credit unions and so on. Perhaps so. But at the same time, these kind of banks failing sends a very bad message. And it does actually worsen conditions in the economy. So you're absolutely right in thinking that there is a little bit of a worry there. So one of the things that these guys talked about, and I've been talking about for a while as well, is the exposure to commercial real estate, right? So not just commercial, but I think residential as well, because we're seeing commercial real estate not do very well. We're seeing residential real estate or housing coming down, right? And when these things happen and you have inflation and people can't pay their bills, you have interest rates going up. Many of these, forget about the mortgages, I'm talking about commercial real estate. 40 to 50% of commercial real estate is on floating rates, which means the rates reset every 3 months, 6 months, 1 year. Okay. So with rates going up, you're having a bigger bill to pay, right? In terms of interest. So this is at a time when you have rentals drying up, because we know a lot of people are working from home. We know a lot of people are downsizing. We know office spaces are being, vacated. And so this to me is quite a serious issue. Now they spoke a little bit about it. I know Powell said that it's not such a big issue as, what we just saw. But the truth is, what we just saw, again, he said this as well, that what we just saw was a one-off case of very bad management. It was, they didn't hedge their books. They didn't manage things well. And I've been using a word which is a bit crude, but I think, the management was just greedy in the way they managed things in the bank. So I think all in all, yes, this may have been a one-off incident, but you're absolutely right in thinking that there does lie a risk in the regional banks as well. Whether it's a contagion or not, as Mayhem rightly said, it might not be an immediate contagion. But I do think that we see serious problems at some of the smaller lenders unless and until they do manage to tighten their conditions and make sure that they have enough liquidity in the system. But the other side of it, the credit side of it, so people defaulting, that's not something they can control, right? That's out of their hands. If people default on a mass scale, they can go and borrow to plug the hole for a bit, but it's not something they can control. So I think things are going to get dire. And one thing that might come out of this is that you'll see like fewer regional banks now, right? So some of the big boys will absorb some of the smaller ones. Few of them will merge. Some of them will go out of business. But I guess all we need to make, hope for at least is, and I know hope is not an investment strategy, but I think we need to hope that none of the bigger ones, bigger regional banks go out of business.
And let's go to you, Tarek. I think that this regional bank thing is just something that we talked a lot about how it's really, we said that for this specific bank, that it was mismanagement, right? I think a lot of people have discussed that, and we're hearing that here today from Mayhem and Aisha. But doesn't it sometimes create something maybe that the other banks maybe aren't mismanaged, but all of a sudden there's that fear that maybe people aren't going to use them as much, or those banks tighten up, and all of a sudden it creates something that maybe necessarily isn't there, but all of a sudden it is an issue, right? I mean, that's kind of what I'm thinking is does that change how business is being done? And from that respect, I look to say, how deep can this go? Because it sounded to me, listening to Mayhem and Aisha, that they acknowledged what happened today, the Fed did with the regional banks. But like we said, it's just not big enough for them to change course. But is it something that they should have acknowledged more? I mean, I guess, what do you think about what they did and the way they acknowledged that?
I think that they did the right thing. They acknowledged it to the degree that was necessary, but they didn't give the still simmering fire of crisis more oxygen to turn into something that it's not. Now, I think that you're right that there's 100%, there are definitely animal spirit issues here. There are people who are concerned about their deposits. There are people who are fearful, and that's been exacerbated quite heavily by some of the messages on social media and even in the traditional media, arguably by some vested interest, but we won't get into that so we don't get sued. But there is that issue that of contagion and of that fear, because people get scared, and people make these decisions based on fear, and that is definitely going to be a factor that we're going to see going forward. But I think that at the same time, it's not something that's going to happen with immediacy. we've seen, the Fed step in, we've seen Treasury step in, and you've even to a degree seen Warren Buffett and Biden step in, sort of trying to calm the horses, so to speak. And I think that's going to buy some time. But I agree with both Aisha and Mayhem that we are going to see more trouble later this year. That we are going to see more issues with these regional banks as they continue to see outflows. I think Aisha's absolutely spot on that we're going to see mergers. We're going to see them, gobbled up by some of the big boys. Some of these ones that have, these really, really good balance sheets that just need a restoration of confidence. But I don't think that in any of that is going to fix the underlying issues. And also, as if conditions do stay tight, which they probably will to at least some degree, the weakening of the real economy is going to also weaken the outlook for these banks, which is going to complicate things going forward. So I think that, it's a multifaceted issue. And I also think that the real economy is really where it's going to be at for Powell in all of this, because if they can hold the banking system together, if inflation continues to stay high as it is, basically in most major economies around the world, with the exception of China, then they've really got to keep the hammer down for as long as they possibly can before they inevitably are confronted with a crisis large enough for them to really have to slam the brakes on, as Mayhem mentioned earlier.
Yeah, I mean, when I was growing up in the industry, and a lot of people talked about, a lot of times these recessions, once they start talking about them, they start to happen just because people are talking about them, right? People stop spending less. And that's when I look at these regional banks, I start to think, is this something that could cause the recession now, right? I mean, something like this. I'm just curious what you guys think about that.
Absolutely, 100%. I mean, the U.S. economy is not in an especially strong underlying position to begin with. And if we do start to see, I mean, there's obviously the lagged impact of rate rises that's still to feed through. The geopolitical situation is still arguably, keeping inflation high, which is hitting, real household incomes quite hard. And yeah, it's just another brick in the wall that adds to the risk of a recession.
Yeah, I think psychologically it damaged a lot of the economy, and just like with the way that people think. And that's kind of what I was getting at before, Aisha. There was, I look at this and say, this could be something that is, it might be a one-off, and the Fed looks at it and says, okay, it is what it is, but it's not really. It could be something that turns into a lot bigger because of change of habits, change of things that happen, the way that the banks start to do things differently, because maybe they start to tighten up a little bit, and all of a sudden you have this spillover. And that's why part of what I was looking at today was like, okay, how is the market going to react to the way that he addresses this? And obviously we saw it. And maybe I think we go to market reactions now, and we talk about gold, right? I mean, I think my first thought when I saw the market start to tank was higher for longer. I don't read into it the way that you guys do, but my mind was kind of going there. That's kind of what's happening, is that it didn't do enough to make the market feel confident and staying long. And I started watching gold just upticking. And I think that, is this a time now, is gold a trade? Is gold really going to do what we've been hearing and people have been saying for however long? Is it gonna happen? I don't know, Mayhem. What do you think?
Oh, gee, gold isn't it the greatest disappointer though? When you're looking for that like game-changing move, like that cup and handle that's been setting up for 12 years, and then it's like wah wah wah, and it just fades. The move completely fades. I feel like I don't want to get too excited, but I do hope that it can at least resume its role of being a place where people can go when uncertainty is higher. And I do think uncertainty is pretty darn high. I saw a couple other things that gave gold a bid here too. The weakening of the dollar, which was pretty darn weak. It was down over 1% when I was last looking at it. And then the bid in bonds, particularly on the longer end. And gold tends to be kind of negatively correlated with the 10-year yield. So I think between those things happening, gold got a bit of a bid. It was also sold down very aggressively yesterday. So we're just kind of getting back to break even if we look at that 2-day trade in gold. So I'm kind of neutral on it here. It's getting up to that nosebleed level where last time people started to sell it aggressively. I'd love to see it start to break up to new all-time highs to feel a little more bullish on it. But I will give credit where it's due. At least it's starting to play its role again as a safe haven in times of greater uncertainty. Maybe not against a hedge of inflation. Maybe that part's not working as much anymore. But at least the uncertainty hedge.
Exactly. It always comes down to the reaction, because when I saw gold start to take off like that, in the back of my mind, I'm going, okay, it's actually now starting to get that attention, right? Because there's so many times in the past where you would see gold try to rally and fail if stocks were going down. You would see this, actually, I'm going to go back to the ES versus gold here. You would see the S&P weakness. If it started to get really weak, it would pull down gold, right?
Yeah.
And I traded through the 2008 times. I remember I was buying a bunch of gold because I was long a bunch of stocks, and I was just getting ripped because the more gold I'm buying, I'm trying to keep in my stocks. I was just getting crushed on both. And I look at this scenario now, and I'm starting to see this actually a strong opposite correlation now that you haven't seen in some time.
Yeah.
And you got to respect that, because it's funny, with all of these things, they don't matter until they matter, right? And it's, you guys know from being great people who understand the macro side of things far better than myself and probably most people listening. And that these markets like gold and silver and even Bitcoin now is in the conversation should act a certain way in certain environments. And then you don't see it and you're like, man, I kind of don't get it. And then all of a sudden, bang, it happens, right? And that's what I'm starting to see in gold. And I feel like gold is now the trade to where if you see weakness in equities, I think you could step in and you can trade gold to the long side. I mean, that's just my 2 cents, just because it's now starting to get proved to me that we're seeing that. I don't know what you think, Aisha or Tarek. Maybe talk a little bit about what you're thinking and seeing in gold.
Aisha,
Yeah, so sure. So it's quite interesting because, as you rightly pointed out, it doesn't matter until it matters. And suddenly gold has, gone back to that recession trade kind of thing, right? So where when we're seeing a recession coming on, we see precious metals go up, particularly gold. So silver is like the poor man's gold, let's say. And so today we're seeing silver go up as well. But what I find interesting today is actually copper and oil. So maybe we'll talk about that in a little bit after we hear from Tarek.
Yeah, I think that gold it's also just a bond story. It's a bond and bond break even story. So as you see real rates on bonds fall, as you see them fall, you do see that move, and bonds have come off a lot. The yields have come down a lot over the last few weeks. Like we are talking about historic moves that basically, in terms of being sort of multiple sigma events that shouldn't happen in the entire history of the universe. In terms of a normal distribution. So because these moves in bonds are so large, it's really having this outsized impact on gold. But the problem, as I see it, is that yes, there is obviously this sort of safe haven trade in gold, but as long as bonds stay volatile, we could see that volatility spread into the gold markets as well. And this is a point that Mayhem made recently on Twitter, was that we are seeing such low liquidity in some of the treasury markets that it's causing these wild swings in bond volatility, which is impacting gold and then spreading out into the rest of the system. So if we do see a return to some degree of certainty within the US banking system, and we do get some more certainty about the sort of direction of the US economy, at least in the short term, and we do start to see bonds rally, then that may not be so good for gold as that certainty returns, the safe haven trade fades, and that headwind coming from bonds, that tailwind coming from bonds for gold starts to potentially reverse.
Oh yeah, no doubt. And what will be really interesting is if that does start to happen, that we talk about with bonds, and gold doesn't respect it and it keeps going up, right? And then what does that signal? I mean, there's always something, right? And sometimes it's what you think the things should happen or could happen, and when they don't, that there's so much information there from the market responses. And look at this 2-year, and let's talk a little bit about this. Maybe we go back to Mayhem.
Sure.
Look at this 2-year. This is a daily chart of the 2-year yield. I mean, it's down to 3.9. This thing is just ripped lower, and I wonder how much that's going to be really truly justified after what we saw today. I mean, what do you think?
Well, we had just had a move that was the biggest move. I think it was 120 bip decline, the biggest move since 1987, I believe, during the crash, where it went down 140 bips. So, as Tarek was saying, we have these incredible amounts of volatility being realized and implied. in the bond market. If we look at the realized side, the price chart tells a pretty convincing story, but we look at the implied side, the MOVE index has surged to, I believe, all-time highs in the last couple of weeks of trading, and that's incredible. And then you look at the liquidity underneath the surface, and the 10-year, the 30-year, the 2-year, the 5-year, everything's trading with just no liquidity. It's like the S&P today, no liquidity. So it doesn't take a lot to move these things a lot, which is scary. Remember the days when the bond market was the most liquid market on the planet? Remember when that was a thing? Because it's not a thing anymore at all. It is completely trading like an equity market or a risk asset, particularly on the longer end of the curve. And so I think it's dangerous, the kinds of rate moves you can get. When you have this flight to safety, people are buying, particularly on the longer end of the curve, but across. And it's been pretty significant, and it's started to have a steepen out of the yield curve inversion, and that usually happens when not so great times are ahead. The inversion at its depth and its duration might give you some clues about what lies ahead with a recession and how bad it could be. But when you steepen out, that's when you start to see the rising probabilities of that recession in the near term. And there's all those sorts of events pulling us closer and closer to that potential outcome, like you pointed out with the regional banks. But I think what's happening with the bond market is it's starting to get more concerned about that too. I do believe the recession trade and also sort of the loss of confidence in what the Fed policy may do to the economy trade is on. And that's part of what we're seeing as well. And that liquidity, the bond market liquidity, is foundational for the rest of the market. I mean, you're talking about the rate setting market for pretty much the entire world, right? So when it starts trading like it's a fire hose with no one holding it, the rest of the market feels that too. And I think it does add to the realized volatility in other assets. And I think it's one of the reasons we've seen some commodities and certainly equity indices, their futures all trade with these wider spreads and lower book depth. And, intraday, the moves have become a lot more choppy. And I think there's a lot more of that ahead because, look, the Fed just told us QT is going to keep going. We haven't injected liquidity directly into the financial system. We don't plan to. These are loans. And so what does that do? It continues to pull liquidity out of these financial markets too. So more of this is kind of the new normal for now. And Powell pretty well spoke to the idea that this is okay. That we can kind of expect more of this. So I'd say whipsaws up and down in the price of bonds, and as a result, the yields are going to become somewhat more normal. I don't know that it's going to continue at the rate that it is now, where we're going to have every day is going to be, incredible moves. But I think it's more likely that lower levels of liquidity in multiple asset markets become kind of a new normal for a while.
Guys, was today a pivotal day? And today, everybody talked about how anticipated this meeting was. And we got the market reactions. We heard from Fed Chair Powell. Is this now setting the tone for what's next?
Deli, can I just say one thing that isn't every Fed day like the most important day of our lives until the next?
Well, no, it's CPI day. Every CPI, it's the biggest CPI of your lifetime. It's the biggest one you've ever seen. No, but wasn't this one? I feel like, and I know I'm not someone who gets on these, these big Fed days and say this is going to be the one that ultimately is going to set the tone or change everything. But I do feel because of what happened with the regional banks, because everybody is focusing on it, I think that the fact that they won 25 basis points, the things that they said today, and from my perspective, right, and I'm not the expert on this panel when it comes to this, I feel like they've kind of stamped it and said that this is where we are right now. And I think by when I saw the way that gold and the markets reacted at the end of the day, and it could easily change in the next day or so, that's how these things are. But I do feel that the markets, as uncertain as we are talking about how things are, I feel like there is a little bit more certainty following what the Fed did today. Maybe I'm wrong, but I feel like that's like this now, at least for the short term. Once the next meeting is not till what? Is it May?
Yeah, May. Early May.
Early May, right? I don't know. I feel like the tone is kind of set. We'll see what happens, but.
I think you might be right there because so all this time, whenever Powell was asked about a soft landing, he was very sure in his response. And he kept on saying, there's a pathway to it. There's a pathway to it. And he was quite sure when he answered that question. today he answered it, and he kind of said we still think there's a pathway, but he kind of got to that after a little bit of a conversation. And to me, it felt like he's not convinced that we're going to have a soft landing. So I read his body language, and the way he spoke about it, and I felt like he's not convinced we're having a soft landing. He has to say it, probably because that's what everyone's thinking. So he speaks for the panel, right? He speaks for the committee. So I'm guessing he can't come out and say that, yes, we're going to have a hard landing. And he doesn't want to cause panic in the market either. But I just felt that there was a little bit of a change there. So I think you're right that there's been a little change in tone over there.
Derek,
Yeah,
am I crazy?
No, I don't think you are. I think that, while things are rapidly evolving for the time being, yeah, I think that we're set on this path of tightening. If nothing else goes wrong, if things continue to evolve roughly as they are, yeah, we are in that sort of higher for longer mode. I think that's really been emphasized here, particularly with the dot plot. I know I keep going on about it, but it is sort of, one of the traditional ways, the Fed sort of communicates its sort of forward intentions and how it wants the market to react to basically it's forward looking at conditions. So I think that you are right, but I think that part of the issue here is that things are just evolving so rapidly. And I just sort of want to just take a moment to just sort of do something a little bit different, if people don't mind. But I'd be interested to hear Mayhem and Aisha's sort of viewpoint on if this bond market volatility could end up ironically creating the contagion that we're talking about, rather than the contagion in terms of, like deposits and all that sort of stuff and, outflows. If we could just see someone big blow up because there is all this volatility in the market, even in, these sort of most, shall we say, normally liquid and normally sort of relatively stable markets like treasuries.
I
can't wait to hear.
I think that it does increase contagion risk significantly. I think that's a really good question because, yeah, these are not markets that used to trade like this. I mean, certainly there are ways for people to try to hedge, and there are ways for people to resize positions and make sure they don't get blown out. And I would hope that type of risk taking, is something that people appreciate. That maybe moderating the amount of risk they're taking on their books is something to consider. But we've seen how some of the risk is managed at these hedge funds and larger banks and mid-sized banks, and sometimes it's great and sometimes it's not so great. So I would say that the potential for that, not only to be a contagion in and of itself, kind of blowing out funds that are exposed more to bonds, I think it's also a volatility contagion in the sense that when you see volatility in such a foundational market, it's likely to spread to other asset classes, particularly as it starts to, as it did recently hit all-time highs. You've got, not just volatility as it's implied, but in the sense that it has been realized. This isn't just nervousness. This isn't just hedging. We're actually seeing really crazy price swings in bonds. And then when we look at order book depth, it's just, there's almost nothing there. And this is spreading. And it's getting worse across multiple asset classes. So I think the other contagion risk is that it could be a multi-asset volatility blowout where, maybe it starts with one position being forcibly liquidated, but maybe that adds then to a thin tape in another position, another asset. And then that, creates a crescendo moment, and then more people kind of get, stopped out forcibly. And then that kind of creates more of a domino moment. We were kind of perilously close to that today. I mean, look at how ES was trading with just 4,000 or 5,000 contracts order book depth. If anyone really big tried to come through there, that could have moved the market pretty violently. So I just feel like we are seeing a growing probability for that, not just as it concerns the bond market's volatility in itself, but also as it concerns broader market illiquidity and both realized and implied volatility as well. I think there's a lot of growing risk there for sure.
Aisha, I mean, before I get to you, I just want to say something real quick. As somebody who's, I've been trading these futures markets for a long time, 25 years now. And I can tell you that I've seen a lot, and I can tell you that when you get into these times where the markets start to get really thin, I could think back for a handful of times where the really big players just don't want to make markets in this, right? And that's the bottom line. I mean, people are always saying, "Oh, there's liquidity there until you need it," right? And the reality is, you look at it from a perspective of a big trader, right? And we're not talking about somebody, who's putting on hundreds of E-Minis. We're talking about thousands, right? And then when you look at it from that perspective, and when you talk about what you're seeing, in the bond market, if they don't feel that they can easily turn out of that position, everybody reduces size. And then ultimately what happens is that look at flash crash type scenarios, right? That was a kind of a unique type of day, but that's the kind of thing where all of a sudden you feel that if you can't make a market where you can immediately get out of it as a big player, you just start pulling bids or offers. Look at what happened in crude oil, right? I mean, who wants to step in and buy the crude oil as is going negative? It's like all of a sudden you can't manage risk because you can't buy here and sell there, or buy here and buy there. And it becomes all of a sudden you just pull in. And ultimately, when you have these types of, markets like this, it's just really signaling that even the big players are like, look at, we don't feel that we could truly manage risk here. Why would we go out and do it? And so it's not that it's representing something even bigger. It's saying that they're not willing to step out and actually put on those positions that keep the market as tight as they normally do, because they don't feel comfortable with it. And if they don't, why should we? And then that's not to scare people, but it's to understand that these moves can all of a sudden accelerate very quickly, because you've got big positions that are sitting out there, and all of a sudden, like what Mayhem said, they've got to start running and getting out of them. And something happens in the bond market. And I don't know if you remember that bond rally. I remember that one day, whereas I don't remember how many years ago that was. Just certain things can happen, and it spills over into everything else, and everybody starts getting flat. And so you have to really be conscious of managing your risk right now as a trader. I know we always talk about that, but when you get to times like this, make sure you've got stops in, folks. That's all I got to say. So I just wanted to kind of like talk about that a little bit before I got to you.
No, I think that's a great point. I mean, that's something that we've been saying a lot as well. I mean, I'm not a trader as such, not like you for sure. But I think the one thing I've been telling everyone is, even if you're trading this market heavily, keep your position sizes small and keep your, stop losses tight, right? I mean, because as Mayhem saying, the volatility is extreme in this market. And that's what happens when you suck out liquidity from a market, right? So, when coming back to your question, Derek, on the bigger, I'm guessing that you were talking about how the bigger banks are managing the risk here.
I
Was that your question?
even just hedge funds with these big option plays and these big shorts that we've seen into. I mean, like we saw, for example, like we saw, well, no pun intended, these big shorts that we've seen in the bond market. Like we saw a record level of shorts. I believe it was on the 2-year prior to all this, and I think that was a sort of catalyst for why we saw, basically a lot of people just getting wrecked as we saw this waterfall in yields. So I'm just wondering, is there sort of, people like hedge funds out there, who are leveraged into this, who have, made these big bets, who could then basically just get wrecked as we've seen, with some other hedge funds in the recent past.
So look, I think I can let me answer it from a different perspective, which is, when you're talking about whether they're leveraged into this, I think the level of leverage is going to be coming off now, right? So one of the side effects of tightening lending conditions is also, pulling leverage. So I'm sure these hedge funds have been playing the market, and we've seen that, right, in the last couple of months, how they've been playing the market. But I think that's going to dry up also a little bit. So I'm guessing they won't be able to do what they used to do before, and I doubt. So in 2018, one of the things that they did do was borrow at the repo desk, right? Like the Fed's overnight repo desk, and that's what caused like a huge problem with the interest rates, and that's why the Fed had to cut rates and so on and so forth. And I don't think the Fed is going to make that mistake again of, freely lending out, particularly now where they have to use the discount window to lend to banks. So I think where the hedge funds are concerned, I think we're going to see a little bit of the activity come off from there. Part of it goes to what Anthony was saying, and part of it goes to, the leverage and the level of lending coming out of the system, credit getting tightened, because that's basically, and I think that that's what could actually break the system, because you have the money supply coming down, and if you have credit availability coming down, then you know what happens in economics, right? So it's like the velocity of money is coming out, and then so obviously you're going to have negative growth. So all things considered, I don't think we're heading for, any good place. And I think you're right, that could sort of spark off, like one could lead to the other, or the other could lead to the one. You know what I mean? So we don't know what comes first. This is the problem. So honestly, I thought if the banks do go under, and I did think that some one or two of the banks would go under, I was warning about regional banking, but I actually thought we would have a solvency issue, not a liquidity issue. I never thought we'd have a liquidity issue before a solvency issue. But then one pulls the other, right? So you have the liquidity issue, and then you can have a solvency issue, vice versa. So it's just a matter of which domino falls first, but the dominoes will fall.
Yeah, I mean, it is definitely, I think today, and I know Mayhem's going to bust my chops about this, I do think that it does set the tone. Because I feel like coming into today, I felt a little bit like, is the Fed really going to, are they going to come in and go back to that soft talk? And because they didn't, I think that markets are responding. We'll see what happens from here. But I know, Aisha, you want to talk about a couple of markets. I think we go to a couple market impacts before we go today. I know we're running a little bit short on time here. And what else did you want to take a look at? I think you said you want to talk about maybe about copper. So I had copper up while you were discussing it. So maybe we get the panel's thoughts here after you discuss what you're thinking on copper.
Yeah. So what I found quite interesting is, like, the last week when we did actually have a problem with the banks and all of that. So both copper and oil was down, and that's the exact recession trade. But today we're not seeing that so much. I mean, copper is still kind of up, and so is oil. And we know what copper is called. It's called Dr. Copper, right? Because it kind of tells you what the economy is thinking. So when copper goes down, you kind of feel like a recession is coming on. When oil goes down, that's also a recession trade. So what we're seeing is kind of the opposite, which is quite interesting, and it's quite opposite to what gold is doing. So I just wanted to point that out.
Yeah, I mean, how about this crude oil chart, guys? I mean, it's funny. I mean, I just look at this chart and it just, like, I got a pain in my body because I look at it and it's one of those things where, I mean, I can't tell you how many times I've been trying to buy the dip in this sucker, and I've stopped. Thank God, as of late. But I look at it and say, what is it telling us? I mean, when you guys look at crude oil, I know you just talked about a little bit, Aisha, when crude oil is going down, but is it down enough to where it is signifying a slowdown, or what do you guys think about what's going on in the oil market?
So
Mayhem
if I
or
may,
Aisha? Yeah.
just to tell you what's happening in this market over here around Dubai and Saudi and all of this. So the market in Brent, I think as long as that stays around $75 a barrel, 75 to 80, we're okay, because this is what the economies over here want to see, right? And so today Brent is at 75, and they'll be okay with this because that's what keeps their economy chugging along. As for WTI, Mayhem, if you want to chime in.
Yeah, I mean, I'll just talk a little bit about what I'm seeing. I think that we're probably at a point where we're not too far from putting in a short-term low. I don't think that supply is that robust. And remember, we're talking about banks, we're talking about credit conditions tightening, we're talking about how that's going to have an impact. One of the impacts is going to be that it's going to be harder for companies across the board to really do much, including explore for and produce oil if they aren't already, to get new credit here. It could be a little bit harder. So that could be one thing that weighs on the market here in terms of the supply side. But on the other side, if the recessionary pressures start to really accelerate, that supply constraint may not be something that we confront. We may not have to see what price discovery looks like in that environment. And instead, the opposite happens. We start to see more builds and we start to see a slower economy push down the price of oil. But I'd say that this is a market with a lot of risk. It's gotten more liquid lately, but it's got risk in both directions, I think. And it's because, you've got that recession risk and it's growing. On the other side of it, you've also got heightened geopolitical uncertainties. You've got the potential for natural disasters. You've got, other things that could complicate the situation. So I think oil, if there was a really big supply disruption, it could be triple digit again, right? But on the other side of it, if we have some pretty significant recessionary pressure, there's no reason it couldn't fall further. But in the short term, I think it's sort of trying to find its range. It seems like it's still trying to find its range in the way that it's trading. So that's kind of the way I'm looking at it. But I think that it's interesting too, because some of the energy companies, even if oil is trading above $50 a barrel, are still doing really well.
Yeah. And let's leave on these final thoughts with everybody. I always like to look at a Fed meeting and say, is today the overreaction? Day 2 tends to be the reaction to day 1, and day 3 is when we start to finally, I think, know how the market was truly impacted by what the Fed did. Because to go off of what today is, I think it's too difficult, because we could say, oh, the market's bearish again. And then I look at the charts and I'm saying, well, slow down there a little bit. I say, oh, gold's ready to go up after today. And I could say, well, slow down there a little bit. But I guess we'll go around the panel the way that we started, but we're going to go the opposite way this time. We'll start with you, Tarek. Biggest takeaway from today, from what the Fed did, from what Chair Powell said, and where you think the market, where the greatest impact we're going to see on the market between now and the next Fed meeting.
I think that the takeaway is high, as you said previously, it's higher for longer. It's the fact that Powell is resolute to fighting inflation under the current conditions, and even I would say relatively resolute to fighting inflation, even if conditions deteriorate a little bit further. Obviously, if you see, if you start seeing, larger issues with larger regional banks or the majors, then obviously that will change. But, excuse me. But in terms of the sort of takeaway in all of this, I think that it's just volatility reigns, and volatility will continue to reign, because Powell provided a degree of certainty about what the Fed is doing, and the market didn't like that one bit. You're not seeing these sort of a return to sort of stability that you would expect. And the thing that I think is really interesting is that we haven't seen a return to stability since all this stuff started over almost 2 weeks ago now. Things are not returning to normal. You're continuing to see these huge moves, huge swings in volatility in the bond market, in the markets more broadly. And I think that is really one of the takeaways in all this, that it's going to still be a little while longer before we start to see things return to a degree of normalcy, and we can actually get a more meaningful signal beyond these massive swings of where things are actually going. Because there's a huge disconnect right now between where the Fed wants to take rates and the bond market. And until that sort of disconnect gets sort of sorted, for want of a better word, I think it's going to be really difficult to determine where the market is actually headed.
Aisha?
So I think the biggest takeaway for me was, him talking about tighter credit conditions and how it could be equivalent to rate hikes anyway. So I think that's an important point. And I think it kind of gives me the feeling that, he is expecting another credit event, which is why he wasn't convinced about a soft landing anymore. So he's seeing that, and he probably can't say it just yet. Maybe they don't have the numbers just yet. But from what I can tell is that we're pretty much looking at a very low level of growth, probably even a recession now. So it's kind of, there. And this is going to lead to higher unemployment, which is obviously part of the hard landing. So as far as markets are concerned, if we do see that low level of growth, that will translate into lower earnings. And for sure, that will take the market down further.
Mayhem.
Yeah, I agree with everything that Tarek and Aisha have said. So my takeaway outside of what they've said is also, the only certainty here is uncertainty. I think that was a big takeaway of the meeting. And I mean that both in jest, but also seriously, that we're seeing uncertainty on both sides of the ledger increase for both inflation and economic and financial repercussions. And I think that we're going to see some of that realized, as Tarek said, through volatility, because that is price uncertainty, really, both in realized and implied terms. And that's going to be a theme because liquidity is being drained. out of the global financial system. And I think that we're starting to see some of the initial dominoes fall on that path towards, I think, what will be later seen as a very hard landing. I don't think there's really any remote scenario where, a no landing or soft landing type of situation happens, unfortunately. And it's just because there's just too much work for the Fed to do. They're not getting the help they need. Now, my outlook would change if we started to see help with the supply side. If we started to see progress, that there was more availability of all these things we need when we get into the next credit cycle, or even, how long prices stay high and how much pressure that puts on households. But I think for the here and now, we're in for a recession that probably starts no later than the back half of this year. And I think it's going to be somewhat nasty, because this seems to be a Fed that's okay with inflicting that pain. It wasn't that long ago that Loretta Mester said that, her and we had a couple other members that echoed similar views. Her view was they're okay with hiking into and through a recession if inflation is still too high. And I feel like the Fed is no stranger to the idea of these episodic bank failures, because this tends to happen during tightening cycles the most. And so there is a higher risk of that outcome. So I think that what we heard today is that the Fed stands resolute to continue doing the work they have to do, and they're kind of doing it on their own with just some other central banks. They don't really have the policy support they need on the fiscal side to make things better. And Neil Kashkari had spoken to that previously. He said in plain English terms that if the Fed had more help with supply, we wouldn't have to do so much to slow demand. So I think the overall outcome for the economy, which I think is already on somewhat unstable footing, where the last GDP print, only 2.2% of it was driven by consumption. The rest was inventory builds and non-defense government spending and mismatches between exports falling less than imports. None of those are good things to see, right? So we're seeing that play out. The consumer stressed, 40% are behind on their bills. 2/3 are living paycheck to paycheck, and that's the biggest chunk of the economy, and they're not doing well. Big chunks of them. Obviously, the more wealthy and the higher income are doing okay, but this is a larger swath of people that traditionally would engage in more high margin discretionary spending that aren't. So I think where this takes the market, as Aisha's been talking about for a while, we're in an earnings recession. That gets worse. We're in a real estate recession. That gets worse, and it all leads us down the path to a real recession. And I think it's going to be a bit of a biter, but I think it's also important to realize we've been in this place of historic emergency level easing on and off for over a decade. There's never been any monetary policy experiment like this in human history. And the unwinding of it is going to be a little bit unpleasant.
Yeah, and I am going to take your words. The Fed stands resolute. When I look back at what today was, I feel like they did. And that's exactly what my takeaway is. And I think that the markets recognize that, albeit very late in the day. And I think the liquidity issues continue because of exactly that. I mean, and I think that that's where we head for markets. So as traders here, watch gold, keep an eye on the rates, the yield curves. Of course, we always keep a little bit of an eye on commodities, but I mean, to me, I think the one thing that I'm looking at as a trader is gold is now starting to really react. And I think that that's one of those things where, as I said it earlier, it doesn't matter until it does. And all of a sudden that could be something that happens where that market can start really moving to the upside. It gets really interesting, especially if equities continue to go lower. I mean, who knows what happens? We have to sit back and watch the tape every day to see. But it becomes a very interesting time. So watch those reactions, everybody. This panel was awesome. You guys are fantastic. You know how big of fans I am of all of you. Tarek, I'm new to following you. And getting a chance to speak with you today was absolutely fantastic. I appreciate you getting up early in the morning and joining us. And Aisha, you know how big of a fan I am of yours and Mayhem as well. Follow everybody on Twitter. All of their links are down below here in the YouTube description. If you're listening on iTunes or Spotify or anywhere else where you listen to these podcasts, their Twitter followers or their Twitter links are also in there. And guys, all I could say is thank you so much. I learned something every single time I speak to all of you. Like I said, Tarek, first time speaking to you, I learned a lot, and I really appreciate all of you joining me today.
Thanks for having us.
Thank you.
All right, traders. Thank you so much for tuning in. I know it was a long day. I know you guys are all tired. Those of you that gutted it out, I appreciate it. Please like and subscribe to the channel and share this out there. These folks really gave a ton of information today that will really help traders navigate the future later. So thank you, everybody. I will see you guys next week. Cheers. Thank you for listening to Futures Radio Show. If you enjoyed the show, please leave a 5-star review on iTunes. Never miss an episode. Go to anthonycrudele.com and get on our email list for show notifications and for free content that is exclusively for subscribers. Also on anthonycrudele.com, you will find tons of videos and education on trading futures, options, and crypto. Past performance is not indicative of future results. Opinions expressed are solely my own and my guests, and they do not express the views or opinions of my sponsors. Futures Radio Show is produced by Crudele Productions.